Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm excited to join you on this Monday, July 19th. Well, we're going to get into five charts that I think are really important to keep an eye on as the market sells off a little bit here. I'm a little cautious in the near term, still very bullish in the long term, but I'll get into all that in just a minute. I do want to let everyone know that you can join our free Earnings Beats Digest community. All you have to do is go to our website at earningsbeats.com and then just look for the boxes down below. This is a free newsletter. You can unsubscribe at any time. There's no credit card required. Simply type in your name and email address and hit that subscribe button. We talk a lot about relative strength, earnings, things that are important to us at Earnings Beats. I think you'll find it to be very educational, provide some trading opportunities perhaps from time to time. But we have a lot of specials and offers and so forth for our community. So we'd love to have you as part of that if you would like to. And again, just go to earningsbeats.com and type in your name, email address. Again, no credit card required. So it is completely free. Also, this evening or this afternoon, we are going to be unveiling our new model ETF portfolio. So that will be occurring at 5 p.m. Eastern today. That will be a members only webinar, but I do want to just point that out in case any of you have an interest in ETFs. We have a free 30-day trial to Earnings Beats, so we'd love to have you come over and check out our service and then join us for tonight's webinar. All right, let's talk a little bit about the market. So the first thing I wanted to do is just point out, and this certainly provides no guarantee whatsoever, but I do want to point out on the S&P 500 that as we've been rising here on this 10-year weekly chart, you can see the move to the upside has been pretty steady, but the weekly PPO has begun to roll over, and you can see it is at a level that we haven't seen in the past decade. Now, part of that is because of the huge rally off of the pandemic lows that will increase the PPO because of that huge reversal and move back to the upside. But still, we are at a high. We do see a negative divergence, and that's just one reason to be a little cautious as we head into the summer months. The other thing that I'll just point out and just give you a couple of numbers here. From July 17th at the close to September 26th at the close, that period since 1950 on the S&P 500 has produced annualized returns of minus 2%. Now, that may not seem like a whole lot, but when you consider that the overall market since 1950 has an average annual return of 9% on the S&P 500, that's pretty substantial. And you might think, okay, well, it's just July to September, so we're only talking a couple months. Well, it's a couple of months of every year for 70 years. So there are now 3,494 days that's part of this analysis. And so that's the equivalent of roughly 13 or 14 years. So imagine if we went 13 or 14 years and we just lost 2% annually every year. I think at that point, probably be a little bored with the stock market. So that's what we're up against as we go into this period in the summer, is that history tells us we need to be a little careful starting now. And we've got warning signs in terms of that slowing momentum, the weekly negative divergence. So just keep all of that in mind. The next chart I have for you that I want you to keep in mind is transportation versus utilities. This is a 10-year weekly relative chart. So this is a price relative chart of the Dow Jones Transportation Average divided by the Dow Jones Utility Average. And you can see the ups and downs and so forth. But what I'll just point out is that when you have this ratio going down, like we saw in 2015, 2016, like we saw 2018, 20 through 2020, when you get that kind of activity, even in a secular bull market, the S&P 500 tends to be very choppy. So while the overall transportation average has been going up, maybe this is just a pullback, we do see this relative price action, transports versus utilities, pulling back here, moving lower, and that is a bit of a warning sign. Now, this could just be temporary, and if it is, that'd be great for the market. We'd like to see this turn back up, this ratio. But for right now, and I'm going to say really over the course of the last 6 to 8 weeks, Utilities have been outperforming transportation stocks. If we're expecting economic strength ahead, transportation stocks should do well. They move goods. So there's no reason for the economy to strengthen and transports not to participate, or to participate, but to do so, less than the utility stocks do. So this is just a ratio that I like to watch, because normally when this ratio is going higher, you can see the S&P 500 going higher. And I actually, down at the bottom here, did a correlation between the ratio of transports versus utilities and the S&P 500, and check out, it's almost always positive. The correlation is almost always positive. So it is important to watch. Currently, we've got this ratio going down, but the S&P has been going up, and you can see the correlation has moved into negative territory, which it doesn't happen very often. So this is just another warning sign to watch. And if transports don't begin to perform well, that would just add maybe to some of the cautiousness that I would employ over the summer months. Next chart I wanted to show you is the S&P 500 and the 10-year Treasury yield. The two tend to go up hand in hand. If you look at the correlation down here, this is the S&P 500 at the top, then you've got the 10-year Treasury yield, and this is the correlation between the two. You can see I've highlighted the plus 0.5 level up to 1.0. That's very strong positive correlation. I did the same to the downside. So this is the minus 0.5 to minus 1.0. And this would be the significant inverse correlation. We don't really see much of that. We see a lot more of the positive correlation. And it makes sense, because when the 10-year Treasury yield's going down, it means money is going into treasuries. And every dollar that goes into treasuries can't go into equities. It's just a mathematical certainty. So if portfolio managers are looking to get into bonds, then that means that money's not going into stocks. But when you look at the shaded areas, these blue shaded areas, when the 10-year Treasury yield is rising, that's when we tend to get some of our biggest moves in the S&P 500. And so with this move to the downside, this is just one more factor, if you will, that simply suggests that we be cautious and that we could have more choppiness ahead. Now, the S&P has been ignoring the yield going down so far during the summer, but that is not the case normally throughout these periods. You can see there we did okay. 2015, 2016, pretty choppy. 2018 through 2020, very choppy. Two cyclical bear markets while the yields were going down. And then you can see we went up back in 2014, but we had periods of time where we didn't really do very well. And if you go back prior to the middle of 2012, you'll see the same thing. Yields were dropping, and we saw a lot of choppiness in equity. So watch that yield, because we are dropping quite a bit here today, down about 11 or 12 basis points. And we've been under a lot of pressure on the yield to the downside. So S&P 500 could begin to feel the effects of that if we don't see things change soon. All right, next up, my fourth chart is the volatility index. Now, when you're looking at the volatility index, just keep in mind that as volatility spikes, we generally put in bottoms. When we get major spikes like we had in 2008, 2020, pandemic and the financial crisis, those tend to mark historic lows that we never see again. And that's what we were seeing back in those two highs. Besides that, more intermediate lows are generally marked in the 40 to 50 range. So these are pretty significant secular bear market. Let's try again. Secular bull market lows. So you can see these tops coming in here on the VIX. They all tended to mark very significant lows in this secular bull market. Well, as we come down, and we did this back in 2008, 2009, we're getting spikes in the VIX, but they tend to not go up higher than the prior highs. And so if I drew a line here from these recent highs on the VIX, probably would come in at about 30, maybe 30, 33. So that's what I would be looking for if things were to accelerate to the downside in terms of equity prices. Then you want to watch the volatility index. because I think if we get up to 30, 35, we'll probably mark a very significant bottom heading into the fourth quarter. Last one I wanted to show you is just an individual stock that I think is probably worth keeping an eye on, Amazon. Now, Amazon had consolidated back in 2018, 2019, finally made a breakout, and then came down. It looked like was not holding its breakout. Never fell below the prior low, though, and then reversed back to the upside. So after a year of consolidation recently, we just broke out again, and now we're seeing Amazon pulling back. I would watch that 20-week EMA, which is at 33.75. I don't know if it goes down that far, maybe even, throw a little monkey wrench into the chart, maybe go a little bit below that. But I think this breakout's significant in Amazon. I think this pullback's an opportunity. So this is a chart that I would certainly be keeping an eye on as we go into the fourth quarter. Summertime, a little dicey. I think weakness can be used as an opportunity to build position in Amazon. But I think by the time we get into fourth quarter, I think Amazon's going to be rolling again to the upside. All right, that is it for me and for your Daily 5 today. I certainly appreciate being here. It was a pleasure joining you today. Please remember to go to earningsbeats.com and sign up for our free Earnings Beats Digest newsletter. And we'd love to have you for tonight's 5 p.m. Eastern event on our model ETF portfolio. Everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.